Hello, everybody. Happy Friday Eve. How's everybody doing? We are almost there. We are almost to March Madness time as well, which also is going to give me the opportunity to tell everybody not to forget to absolutely sign up for our free trading challenge, which starts on Monday. We have the opportunity to win 6 months access into any room you like, mentorship possibilities, all that good stuff. All right, everybody. Wanted to do this the last couple days, but unfortunately didn't have the opportunity. So today, we are going to talk about reward and risk and what is the right signal at the right time. Okay. We can skin a cat a million different ways: bullish, bearish, neutral. But when is the most opportune time to put on a certain position? And what does it come down to, everybody? It comes down to reward to risk. Okay, everybody with me? Everybody see Trading Den? Thank you for smashing away. Good day, Bushman. Herbert, hello. Hopefully everybody is doing well. All right, I see we're getting a lot of people in here. That is good. So, what is risk and reward for traders? Why does it matter? Every trade you make, everybody, every trade you make, no matter what it is, no matter, has some level of risk to it and obviously some reward. Okay. And the risk on a position, the risk in financial markets, is seen as a measure of the uncertainty relating to the outcome of your trade. There is never, ever, ever, ever a 100% guarantee the markets are going to behave the way that we expect. Just like right now, everybody pounding the table, beating the drum on oil again, and thinking that it is going to explode again. Yes, it is up a lot from where we were yesterday and the day before, but lots of FOMO going on right now. Lots of herd mentality about here. Let's see. Iran's supreme leader vows to keep blocking the Strait of Hormuz to pressure the enemy. Might happen. Sure, might happen. Maybe we'll see oil prices go up. Maybe we'll see them come down. What happened the other day? They went down $40 a barrel. Okay, so we know what the risk is. What's the reward? Well, the reward, it's obvious, right? What can you make from a trade or an investment? What is your profit? So, what is the reward to risk ratio? Most of the time, when you look up risk reward, reward to risk, and you do something on, look it up on Google, whatever, you're going to see this defined as risk reward. I define it as reward to risk. In other words, how much reward can we make for the risk we're taking? Not what is the risk we're taking based on the reward we can make. So it gives us a way of assessing the expected return on a trade per unit of risk. And we measure that unit in dollars. Okay. So if we risk $100, but can make 300, okay, if we risk 100 but can make 300, our R ratio, again, reward to risk, is 3 to 1, or meaning that unit that we're using of $1, for every dollar we're risking, you can make $3. Pretty simple, right? Everybody understands that. Everybody understands that. And again, I choose to use reward to risk, not risk reward. Okay. Now, we all know what this is, right? Standard bell curve. Why is this really, really important in our decisions? Why is this important when we look at reward to risk ratio? Anybody have the answer for that? When we are calculating our reward to risk, what is so significant about this graph right here? Okay. I just circled it, but I want to see some answers here. Okay. Our baseline, our baseline is calculating whatever spread we come up with, whatever signal we come up with based on this one standard deviation move. 68% probability. Now, if we wanted to expand that, which we easily could, and we wanted to say, okay, what's the 2 standard deviation move? What's the 3 standard deviation move? Sure, we could absolutely put positions on, excuse me, based on that. But when we identify our reward to risk opportunities, and we're going to go through them here, whether it's 2 to 1, 2.5 to 1, 3 to 1, 4 to 1, whatever it is, okay, you must understand it is all based on the normal distribution curve of a 1 standard deviation move, which is the expected move. Okay. So if we wanted to find a potential trade opportunity that had 8, 9, 10, 15 to 1 reward to risk, sure, we could do it. But that's not going to fall within the confines of using this as our baseline. Okay. Does everybody understand that? So anytime that we come up with what is the reward to risk on this potential trade setup, it is because we are looking at the expected move, 1 standard deviation. Okay. So before we place a trade, okay, we've got to understand the leverage. How does it work? How will it impact the outcome of our trade? The more risk you take, okay, and this just makes common sense, the more risk you take, the more potential payoff you should have. Now, the lower the probability that that trade is going to work for you, but if it does, the higher the payoff. And vice versa, the less risk you take, the lower that payout is going to be, but the higher the probability that the trade is going to work. Okay. Which is why, again, we always have to have a constant, consistent baseline. We don't want to look at something and say, hey, this one's 8 to 1, but this one's only 2 to 1, right? Because we wouldn't have a consistent baseline for measuring the probability of success. So, this is something that all of our students have. You won't find this by Googling this. You won't find this on the internet unless someone has posted this exact Prosper Trading Academy reward to risk guidelines. These reward to risk guidelines that you see here, okay, these were formulated not from some big algorithmic equation. These were literally calculated from mine and Mike Shore's, Charlie Moon's, hundreds of thousands, if not millions of trades over time. and looking at and determining when is it worthwhile to put this type of trade on. And what you'll all also notice here is that reward to risk changes based on the type of strategy, the scenario. Is it earnings related? Is it not earnings related? So, again, these reward to risk guidelines, which we do adhere to, okay, this is from our own personal trading experience. If you fudged them a little bit, because you found something else, that's fine. This is our personal trading experience based on calculating probabilities of that one standard deviation move. Does that make sense to everybody? Okay. Maybe, at some point you may trade with your own subset, with your own sweet spot of where you feel the best reward to risk is based on whatever inputs you are using. Now, before we get to the different types of signals in the different types of scenarios, I didn't use Luella today because I thought this was just such an unbelievable picture of my dog Bear just staring out the window, not knowing what is in that empty head of his. So we are going with the word thoughts today. That is our word of the day. Make sure you get that up in the chat. Give that another minute or two. He is really a sweet dog. Thank you, thank you, thank you. He's actually a service dog too. So he goes with us everywhere, goes into schools, goes into nursing homes. He is really, really a heck of a dog. He's a golden doodle, Milesy. Yep, he's a golden doodle and a big one. When we got him, he was our pandemic puppy. We got him literally right at the beginning of the pandemic, and breeder told us he was going to be, somewhere 50-ish pounds or so. 85 pounds later, lap dog. But sweetest, most gentle that you could ever imagine. And his name is Bear because he looks like a big teddy bear. Okay, let's get back now. How do we determine what types of strategies that we want to employ? Because we're not always just going to trade the same strategy. If we get locked into trading the same strategy, yeah, sure, there's a comfort level to that, but you will be, hang on one second, guys. This is a 30-year bond auction that is very, very important. Okay, it was pretty well received. We might see rates ticking down a little bit. We might see treasuries rally a little bit right now and rates come down. This was a pretty widely accepted 30-year auction. We'll watch rates here. Anyway, the market is dynamic. The market is changing. We're putting on different types of positions strategy wise now and over the last week than we were 2-3 weeks ago, right? As implied volatilities change, we need to be adaptable. Can Bear play safety? He plays both sides of the ball, AJ. Shifty fella. Shifty, shifty fella. Problem is, he'd get called for a lot of blocking below the knees because when he comes running, when we get home or something and he comes running at us, he doesn't know how to stop. All right. So the market is dynamic. We need to be dynamic. Okay. There are times where certain strategies work better than others. So I created this. Okay. This is not the end all be all. This is not encompass every single kind of trade out there. Like I said at the beginning here, we can get to a certain outcome using literally almost a limitless amount of different strategies. But these are going to be the ones that we focus on. These are going to be the ones that even beginners can really learn, understand, use, and employ right from the get go. Okay. So these are our go tos. And what you'll all notice here is what I've done is broken this down first by direction. Okay. So if you're bullish, we're going to look here. If you're neutral, we're going to look here. If I'm bearish, I'm going to look here. However, then the subset of that is, okay, what do you do depending on where volatility is, depending on where implied volatility is? Okay. So, for instance, in these first two right here under the bullish column, simplest thing, simplest spread to put on is just buying a bullish call spread, right? Costs me money. It's a debit. Sure, that's easy. I want to do that when implied volatility is lower. I don't necessarily want to just buy a call spread if I'm bullish when implied volatility is higher. There's other things I'd rather do to accomplish the same objective. So when vol is high and I'm bullish, I might rather sell a put spread than buying a call spread. Okay. Another position to put on if I'm bullish and implied volatility is really low and I want to buy time. Okay. Because remember, when vol is low, that means time is cheap. Okay. I could buy a calendar call spread or a diagonal call spread where I'm buying time when time is cheap. Okay. Now, butterflies, specifically broken wing butterflies, which we trade all the time. The reason I love broken wing butterflies, call or put, doesn't matter, is because they are, for the most part, volatility neutral. So if vol is trading in a fair range, or you're kind of uncertain whether it's cheap or expensive, a broken wing butterfly, again, call or put, bearish or bullish, is really a great position because it gives you the delta direction without having the vega or volatility risk. Okay. And then something I think that this might be the signal to trades that we put on the most over the last week or two is this right here. Selling a long delta bias or bullish iron condor for nice credits. Right? How many of these have we done over the last several weeks? And we have a few on right now, actually. So we've talked about the iron condor. That iron condor is typically, we think of it as a neutral trade, right? Range bound, but it can be set up to be directionally bullish, directionally bearish. Okay. Does everybody understand kind of how I laid things out here? Again, this is not all encompassing. It is not the end all be all, but it is one heck of a guide that you're not going to find elsewhere to at least just connect the dots. So if you know enough to say, hey, I'm looking at the charts, I'm bullish, but boy, it seems like implied vol is really expensive. Okay, match those two up. Match those two up. Okay, let's move over to the neutral column. Okay, if you are agnostic direction, okay, looks like maybe stock's in a range, not really going to move much from where we are. Iron condor, neutral iron condors, where the strikes are same distance away from where the stock is trading. Excellent. Selling an iron butterfly, which is almost the exact same thing as an iron condor. Okay. Buying a strangle swap. Okay. And that you would want to do when vol is low. Okay, then we can go into the bearish, and the bearish column is going to be pretty much the exact as what we saw in the bullish column, but just with puts instead of calls. So when vol is really low and you're bearish, what is really just the kind of the most basic, the easiest type of spread to put out there is buy a put spread. Buy a put spread when vol is low. Okay, if vol gets high, okay, and I'm bearish, well, instead of buying a put spread, I may want to sell a call spread. Okay. And then so on and so forth. The rest of these really kind of follow the same direction as in the bullish column, but just using puts instead of calls. Okay. Any questions on this matrix? Because I want to go back to the reward to risk chart in a moment. But any questions on this matrix? Okay. So let's go back here for a moment on our reward to risk guideline spreadsheet here. Something you're going to notice is on our debit spreads, okay, we are typically looking for a much higher rate of return than on credit spreads. And yes, Dave, when I specify low or high vol, we're talking about IV rank. Yes, exactly. Okay. So if you think about it, if someone is giving you money for something, okay, if you have the money up front, you're more than likely willing to take a little less odds to give it back, okay, because you have that money up front. Flip side of that is, though, if I've got to give someone else money, if I've got to pay up front, I got to get better odds coming back at me. If you're taking my money up front, I got to get better odds coming back at me. Does that make sense? So, in the case of just this simple debit call or put spread, where we're looking at 2.5 or 3-1. Remember, that is reward to risk. A lot of times, if you look this up, if you're doing research, you are going to see the opposite. You're going to see that labeled as risk to reward, where you might see 0.3-1, 0.3-1, so like 33% instead of 3-1, which is 300%. Okay, so just keep that in mind. All right. Oh, we changed it up today. Look what Mike Clark did today. I'm going to put on my championship Indiana hat just for the occasion. Just for the occasion. Thank you very much, Michael Clark. All right. Let's give it a whirl here. I love the IU spin. Today's winner, is it Alice? Is it Bear? Who's it going to be? Alice Trader. In the house, Alice Trader. Alice Trader, are you in the house? See lots of congrats. There you are. Yes, you are in the house. Absolutely wonderful. All right, everybody. That is going to give us a wrap for the day. Appreciate you all being here. And I will see you all tomorrow.